Thanks for clicking! All eyes were on the Bank of Canada this morning as it was set to make its final interest rate announcement of the year, with the majority of economists expecting the bank to continue its rate hold. We got our answer at 10 a.m. this morning when the bank did indeed hold on rates, keeping the policy rate at 5%. And the hold on rates will no doubt amplify the deluge of rate predictions that we've been seeing over the past few weeks. Most recently coming from CIBC's Benjamin Tal, who's predicting 150 basis points worth of rate cuts in the latter half of next year.
I love you.
And the rate cut predictions are not just here in Canada, with some calling for 5 rate cuts by the Fed in 2024, with interest rate futures currently predicting 125 basis point rate cuts in the US throughout next year. Yet, as we'll see today, the two economies are on very divergent paths, with the US economy humming right along and the Canadian economy barely avoiding a recession in the third quarter. So what I want to do today is go over the Bank of Canada's policy decision, look at the projected spread between the bank's rate and the Fed's rate going into 2024 and why that matters, take a look at the US economy compared with that of Canada's, and then discuss some interest rate considerations going into 2024. As we'll see today, for the Bank of Canada, the CPI is paramount, and Canada's inflation data is set to be released in a little less than 2 weeks, which will obviously have a big impact on the bank's policy going into the new year. We'll obviously have an update out on November CPI data when it's released on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this policy announcement. On to the announcement. As mentioned, the Bank of Canada surprised almost no one this morning when it announced it would be holding on rates, keeping the policy rate at 5%. The bank opted to release a policy statement, foregoing the usual press conference, where they answered the same question 20 times.
I'm not going to tell you again.
The statement noted that the bank recognizes that rates are cooling the economy, though it still expressed a concern that wage growth is still running at 4 to 5%. The bank mentioned the slowdown in Canada's core inflation data, noting that October's data came in lower, but stressed that the bank is still looking to see a sustained slowdown in core before it considers cutting rates. So, as we talked about so many times on this channel, the Bank of Canada, whose sole job is to fight inflation, will look to inflation when deciding its policies.
Whoa!
Yet, as mentioned, predictions of rate cuts are widespread, with the most recent coming from CIBC's Benjamin Tal, who noted that not only is the Bank of Canada going to cut rates by 150 basis points next year, but they will also lag behind the Fed, which will only be cutting by 50.
2024, we see the Bank of Canada cutting by 150 basis points, the Fed only by 50 because the Fed will start much later than the Bank of Canada.
So, if Tal is correct, that would put the bank's policy rate at 3.5% and the Fed funds rate between 4.75% and 5%. So about a 1.25% spread between the Bank of Canada and the Federal Reserve. One brief side note, at the very end of the interview, Tal noted that, by definition, the policy rate has to be higher than the inflation rate.
More inflation coming in the system, and you have the same target, 2%. By definition, interest rates have to be higher.
And this definitely isn't a surprise to us on this channel, as we've been through decades and decades worth of data showing that the policy rate is almost always higher than the inflation rate, and the prime rate has only had 2 instances where it wasn't higher than the inflation rate. But this is indeed a surprise coming from Tal, who, along with all of the other banks, back in February of 2022, when inflation was sitting at 5.1%, were predicting policy rates of 1.25% to 2% by the end of 2022, and 55% of borrowers took variable rate mortgages. So, grain of salt.
I just remembered.
Regardless, if Tal is indeed correct, Canada will have a policy rate 125 basis points lower than that of the Fed. Yet, if we look back at the data, if we look back at the usual spread between the Bank of Canada and the Federal Reserve, we can see that that is a big spread, with the only comparable difference when the bank's rate was that much lower than that of the Fed being between April of 1996 and August of 1998. And the reason why the policy rate usually matches that of the Fed within a few basis points is that when it doesn't, the demand for, and thus value of, our currency plummets.
Whatever it takes.
In fact, during those 2 years, the value of the Canadian dollar fell by 15%, and when the value of the Canadian dollar falls, we get imported inflation. As it costs 15% more, we need 15% more Canadian dollars to buy the same amount of imported goods. And we probably would have had more inflation during that 2-year period were it not for Canada's unemployment rate starting out that divergence at 9.3%. 3.5% higher than it is right now, and higher than it was at the height of the global financial crisis. Bank has almost always maintained a policy rate higher than that of the US Fed, averaged at 60 basis points higher over the past 60 years, but that's neither here nor there. Yet, Tal is saying that the spread between the bank's policy rate and the federal funds rate is going to be 125 basis points by the end of 2024. Not as high as it was in 1996, but the highest that we've seen since. And, as we just saw, the only reason the Bank of Canada was able to get away with that in the late 1990s was a sub 2% inflation rate and the highest level of unemployment, except for COVID, that we've seen in the past 27 years. Which leads us to the question, is that the base case for Benjamin Tal? Does he see the CPI moving below 2% in 2024 and unemployment being over 8% in 2024 enough that would justify that big of a spread between Canada and the Federal Reserve? But maybe that's not the case. Maybe the spread won't be that big. Maybe Tal is wrong. Maybe the predictions that the Fed is going to be able to cut rates by 125 basis points next year will turn out to be true. And then the Bank of Canada can cut rates by 150, the spread won't be that big, and we won't have to worry about a depreciating currency.
Don't call here again.
However, as we mentioned, the US economy is humming along, with the unemployment rate coming in consistently around 4% for the past 21 months, its longest streak since the 1960s. Its GDP just came in higher than expected at 5.2%, and core CPI is sitting around 4%. Compare that with Canada, which is on the verge of a recession. Unemployment is sitting at 5.8%, and core CPI came in at 3.5% and is slowing. Will these two central banks, will the Federal Reserve and the Bank of Canada have the same policy rate or similar policy rates when the economies are in two massively divergent positions? So, it's not clear, as of yet at least, that the Federal Reserve is going to be able to cut as drastically as is being predicted by the markets. So maybe Benjamin Tal is correct.
No doubt in my mind.
If Tal is correct, if the Federal Reserve is going to lag behind the Bank of Canada, if the Fed funds rate is going to be 1.25 points higher than that of the Bank of Canada, then that will be one of the very few times over the past 60 years that has happened, with all of the inflationary risks that come with it. If Tal is wrong, and the Fed is going to cut by 125 basis points over the next year, then, right now at least, it looks like they'll be cutting into an economy that is still fairly resilient, with all of the inflation risks that come with it. So, we have the Bank of Canada holding on rates, and predictions of rate cuts for 2024 are upon us. From Benjamin Tal's 150 basis points that we heard just yesterday, to Rosenberg's 200 basis points that we heard last week. But, as we saw today, the policy rate environment does not occur in a vacuum. It works within the global economy. It works in conjunction with our neighbor to the south. And when we're discussing rate cuts, when we're looking at rate cuts next year, both the timing of and severity, we need to be cognizant that the Bank of Canada very much does not plot its own course. It, too, very much has to be cognizant of what is happening in the United States. With that said, we will obviously continue to track Bank of Canada policy and our interest rates going into 2024, as well as how that's being affected by what's happening in the United States. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.